All right, everyone, let's begin. Let's begin. My name is Nilay Goyal, and I'll be your host today. I'll be joined by my co-professor and my colleague, Ash Singh. Uh, welcome to today's session about scaling and raising capital in a COVID-19 era. We will be going over some of the aspects of the about fundraising in the COVID-19 world, and we'll be doing a live pitch session as well. So, while we begin, let me, just make sure that sound is working. While we see this video, please type in again on the chat your country and city from where you're joining us. Thank you. All right, so, I hope everyone could hear the sound. Ash, were you able to hear the sound?
Royce? Yeah, it was loud and clear, my friend, loud and clear.
That's awesome. Thank you, Ash. All right, so, let's begin the session today. Just to set the expectations right, we are all here to learn and treat this as an opportunity to learn and grow. Please feel free to contribute and share your thoughts and intent with the intention to improve everyone's experience. And please respect each other's options and thinking, and please maintain confidentiality as well. We might have certain pitches being presented, and let's make sure that whatever is said in the class stays in the class. Just to introduce ourselves, I'd like to introduce myself first. So my name is Nilay Goyal, and I'm an entrepreneur. I've built multiple companies. I had my first exit, or I sold my first company at the age of 23. Since then, I've co-founded multiple different accelerators and two of the largest universities in Canada. As the co-founder of the Creative Destruction Lab at the Rotman School of Business at the University of Toronto and the Innovation New York Entrepreneurship Programs at York University. Over the years, I've worked in diverse industries and worked with hundreds of entrepreneurs in various sectors and various stages of their development. So far, I've mentored or coached hundreds of entrepreneurs who have raised over $275 million in funding. And we hope that, sharing some of our insights from this experience could help you could help you in just powering your entrepreneurial journey as well. So that's about me. I'm co-joined today by my colleague and co-professor, Ash Singh. Ash, would you mind introducing yourself?
Sure, happy to do that. Good morning, good afternoon, good evening, everyone. Always excited to have these Thursday sessions, Nilay, these virtual pitch events. I know you're going to cover some really cool stuff around raising capital, but I always get excited about pitching and hearing some people live today. So thanks again for inviting me to join. My name is Ash Singh. I've been a career entrepreneur. I was born in Canada and built my first company in my early 20s. We built a social networking software company for corporates. This was when MySpace and Friendster was all the rage. So I'm kind of dating myself. We had our exit, and we exited that business in 2004. We sold the business to a media agency in Singapore and went on to build a couple of more companies. I raised $10 million for McDonald's to build a private loyalty program, the largest private loyalty program in Singapore, and went on to raise money for several different ventures because I really enjoyed that process, which is why I'm really excited to be here, because I think some people here want to, get some insights on how to fundraise. But through that journey as well, we produced the Dragon's Den, the Shark's Tank, reality TV show in Singapore called The Angel's Gate. And I am also a big basketball fan. So I'm a co-owner of the Singapore Slingers professional basketball team. So really enjoy doing that. These are just kind of things about myself, but most importantly, over the last 15 years, I've invested time to teach startup and entrepreneurship. Okay, and so that's kind of my focal point. And so you know, with all the things that are going on today in today's world, I was sorry, give me 1 second. Let me just adjust this 1 second. Nalay, can you see me? Are you okay? Are you okay?
Yes, I cannot really see your video, but it's okay.
No problem. No. It should be your video, my friend. Are you okay?
No.
You should be sharing yours.
Nope. Okay.
Oh,
yes, I'm able to turn it on. Yes.
No.
Wait.
Don't worry about my video. Just share your screen. Just share your screen. Yep. Don't worry about that. Okay. You're okay?
Yep.
Yeah. Don't worry. I'll enable my video when I have my unveiling of our elevator pitch session, my friend. That's the more fun part. Okay.
Okay.
But you're still sharing your screen, right?
Yes.
Okay. Great. Excellent. Perfect. Sorry, guys. I was just a little bit of a technical glitch today. We were trying to get this going across a couple of other platforms, and so we're just making sure the technical components are working. What I was saying earlier was around my focus on entrepreneurship and entrepreneurial teaching. So we've been running our programs around the world. Our students have raised, we'll just go to the previous slide, Nalay. I think you're a little trigger happy today.
Yeah.
Just go back
Sorry.
to the back one. Yeah, right here, just leave it here. So we've been focused on teaching entrepreneurship. And what we did is we spent a lot of time trying to understand why first-time founders fail, and also wanted to equip students with the ability to raise money. That's kind of the most important component of startup, if you're able to get money from customers as well as from investors. So our startups have raised over $1 billion of capital over the last 10 plus years. And we've had the opportunity to teach around the world. We'll go to the next slide, Nalay. We've had the opportunity to connect and build companies in varying industries, age groups, a lot of diversity around the world. And we're going to share some of those insights with you today. The other thing is we've taught at the high school level, college, university, and worked with some of the top corporates around the world. And so we've discovered some patterns, and we hope that you guys find value today as we go through this journey to level up your skill set. Part of the journey is also around working with startups. So we've had the pleasure of working with some very interesting startups. And these are some of the startups that we've worked with that have taken our program and gone on to do some what we feel is really exciting and incredible things. Now, the top layer is some of the startups that were part of the startup program that we ran at INSEAD. And the bottom one is stuff that Nalay, some amazing startups that Nalay has worked with as well over the years. So let's scroll to the next section, because I think the other part about it, and we don't know who might show up today. We try to invite these people back. So if you see some of these people in the chat, you never know who's on the chat, and there might even be an opportunity. You never know if there's an investor, because we do invite them in to attend these sessions. So former students that have gone on to build companies, or investors themselves. So let's see if we can make this valuable for everyone on the chat today. So with that, Nalay, I'll hand it back to you.
Thank you, Ash. And it's a great introduction. And one of the things that we want to emphasize is we've kind of worked with entrepreneurs for a long time, for 15, 20 years. And what we're going to share is some of the insights from our journey and our experience with entrepreneurs at different levels. So what we did was we took some time to understand who is joining us today for our session. And we found that we have people from about 10 different countries joining in, including some familiar faces. And thank you all for joining us. We like to, make it relevant, we might like to make the session, customized to your needs. So what I'm going to do is I'm going to launch a quick poll just to understand why are you here. So can you guys see the poll? Just please answer, why are you here? Are you here to learn about startups? Are you looking to improve your startup that you're already working on? Are you looking to fundraise? Or are you an investor looking to invest? And if there's something else, please make sure that you mention that and you type it in the chat as well. So. We'll give it 20 more seconds before we close the poll. But yeah, it looks like a lot of people are here looking to improve their startup or raise funding for their existing ones. Cool. I'm going to end the poll. So yeah, overwhelmingly, we see that you're looking for ways to improve your startup, and looking to raise funds as well. So that's the predominant situation. So what we're going to do is we will make sure that we cover those aspects. Quite a few of you are looking to fundraise as well. So what we're going to do today is we'll start off with a quick one-sentence pitch in the chat. So, and then I'm going to present for about 10 minutes or so, report on the COVID-19 fundraising. So we're going to share some data and insights from from a study done about fundraising in the COVID-19 era. And we will talk about the 12 steps required to be an investor, and then do a 1-minute elevator pitch. That's the agenda for today. To get started with the elevator pitches, please use the chat feature to type in your one-sentence pitch. So please use the chat feature from the bottom on your on Zoom, and make sure you have selected all panelists and attendees, and type in. And we recommend this, the same template here about my company, and the name of your company is developing a defined offering to help a defined audience solve a problem with some secret sauce. So I see some of the I at least see 2 pitches. No, it's just 1 pitch from, say, already. Please feel free to type in your company's pitch into the chat as well, and we'll invite you at the end to present to the entire group. So that's the first step. Make sure you use this chat feature in Zoom. If you're not aware of this, just type in your question, and so some of our colleagues, Roy or Simon, could help you with that too. So let me start off with just presenting a report about funding changes in the COVID-19 era. We are in kind of an unprecedented time where we see, the COVID-19 pandemic has caused a lot of disruptions in a lot of different sectors, including the capital markets and the way people are allocating funds. However, while the current situation is quite unique, we do see some similarities with what happened in 2008, where we had a similar crisis hit the capital markets. So, we are trying to understand what are the funding changes that happen in this era, and how can entrepreneurs best navigate this. So we start off by looking at historical data and looking at 2008 downturn. So if you look at the investments that went into startups in 2008 and 2009, you see there was a significant dip between 2007 and 2009 in overall funding. However, when you look into the details, you will find that it's actually, the larger stages of funding, like the Series C was cut into 1/3. Series B was almost half, and Series A half as well. But the seed stage funding actually just doubled. And what we saw was that, while there was a decrease in overall amount of funding that went into venture capital, there was a significant increase in the amount of funding that went into seed capital. So a lot of early stage startups actually got funded. A lot more got funded than what you see typically. And we see the same things, in terms of the deal volume too, though we don't have the exact data from Crunchbase about the seed stage startups. But this tells you something. This tells you about the realignment of a lot of investor strategies in terms of how they allocate their funds. Now, when you look at some of the recent data, there was a survey conducted of about 400 entrepreneurs and investors. And they found different, the survey's intention was to find out the impact of COVID-19 in fundraising industry. So when they were asked about what are the founders' biggest concerns, most founders said about VC money drying up. A lot of them were also concerned about sales declining and team morale and layoffs. But you see the sector in jeopardy came in quite at the end. And, so that means a lot of them feel relatively confident about their sector or their industry surviving through the pandemic, which is interesting, just talking about the founders' main concerns. Now, if the founders are fundraising, the survey asked what are the observations in terms of the VC responses. And predominantly, if you look at this, most of them, about 90%, actually said that VCs are either not responding or responding slowly. And this also kind of tells you something because, there's a significant delay in which the VCs are responding. Now, when you dig deeper, ask a similar question to the VCs about where are they spending their time right now. What you find is that most VCs are spending way more time working with their portfolio companies rather than evaluating new deals as they used to earlier. So if you look at, evaluating new deals was the largest part of their time allocation. And second was working with the portfolio companies. This has just switched. So this actually correlates and confirms that, VCs are not spending as much time right now evaluating new deals. And part of it is just because they're trying to make sure that their current investments yield the returns. But at the same time, I think this might change as we go along. They might be looking at new deals as well when we start seeing this. Now, typically with any situation like this, there is a change in valuations. You see that in public markets as well to some extent, but in the private equity industry, you see that the founders themselves are expecting quite most founders, like 50% of them, are actually expecting lower valuations, and they're expecting the valuations to be lower by almost 20 to 30%. So if you're fundraising in this era, if you're running a startup, do expect your valuations to be lowered down a little bit than what you would have expected 6 months ago, because the current scenario does kind of, it does make some changes in terms of realignment, in terms of how the growth expectations and how the return on investment is being calculated for the investors. Now, when we ask founders about what changes are they making within companies, you find that majority, the top 3, are all related to cutting expenses. So either they're cutting office expenses or marketing spend or hiring freeze. Though, only 35% of founders are actually, looking to pivot the product, which is also very interesting because in these times we see this is actually in some sense the current situation is a little bit different than 2008. The current situation, we see a lot of change in consumer behavior happening right now across the board, across industries, across the world, which we didn't see that happening as much in 2008. So at this time, if you're running a startup, pivoting a product or looking at what is your value proposition and asking those hard questions about it becomes way more important. And I think this should feature much more prominently for the founders than it did before. All the others are, again, related to cost-cutting measures. Now, when asked about VCs about how many of them are looking to shift their investment strategies, we see that there's like a half and half split where 50% or 51% say they're not looking to shift their investment strategy, but almost 50% are actually moderately or significantly changing it. And we'll see this happening more and more. We'll see the shift happening between VCs shifting their strategies as the months go by, because part of it is that VCs typically invest money, given to them by their LPs, limited partners, which are typically the banks or the investment funds or insurance funds, and a lot of those funds are actually facing a lot of losses in other asset classes, including bond market, the credit market, and even some in the stock markets as well, depending on their exposure. But as the LPs, the people who give money to VCs to invest in startups, as they start feeling the pinch in other asset classes and other investments, they would try to put some pressure on the VCs as well. And it'll take some time before that happens, but you will see a shift in investment strategies by the VCs going forward. Now, with all these changes happening, we often talk about how to win over investors in 2020. And the fact is that, with the changing landscape, the investor community is actually looking much more deeply at the fundamentals of a company than they did before. And, fundamentals, in getting your fundamentals right for your startup are extremely important. And, as I say, like, if you can master the fundamentals, the rest becomes much more easier. And so for an entrepreneur, if you're looking to fundraise in the current era, or if you're looking to improve your startup, one important question is how do you make sure that you don't have any blind spots in your fundamentals? So, I'm gonna start off with some of the 12 reasons that we found about how to win over investors. Over the years, as we said, we have worked with hundreds, if not thousands, of entrepreneurs, and we've got some research done about why first-time founders succeed or fail. And what we found was that there are 12 main reasons because of which founders fail. And those 12 reasons fall in an order in which a company's stage aligns. And I'm going to talk about those 12 reasons with you. So we find that most entrepreneurs fail to excite investors early on because either they don't have a good idea or they're starting off with a very good idea. They often don't have the right foundation. And what that means is that they don't think about where to incorporate, where to operate, and they don't have the fundamentals of the corporate hygiene set in. Also, we find that entrepreneurs often don't think big enough. We're living in a exponential world where we are seeing a lot of changes happening, and with these changes, you have to think globally, you have to think exponentially. So it's important for you to figure out, to think big enough and make sure you're prepared for the exponential changes. Now, as you go along, as you start building your startup, as you plan to launch, we find that a lot of entrepreneurs fail to understand what their value proposition is. By value proposition, what we specifically mean is, what are the things that your customers want? Okay, and investors look at this very seriously because it's important to know that that you as a company is satisfying a real need for your customers. We also find that entrepreneurs often are unable to assess the market well. Specifically, you should be able to identify how big the opportunity is and how much of it are you able to acquire in a meaningful way. We also find that, often entrepreneurs fail to get their first product launch. So what we mean by this is that entrepreneurs don't often get their first minimum viable product right. And often, like me being an engineer myself, we often see that in entrepreneurs, like engineering entrepreneurs, like we're engineers, often try to load their first prototype with a lot of features, which are typically, technically challenging to build, because that's what challenges us as engineers. But what's important is that, your minimum viable product should just satisfy your customers' needs and wants and provide the value proposition in the best possible way. So in order to make sure that you are able to launch that minimum viable product in an efficient way is important. And finally, what we see is, entrepreneurs often fell into the valley of death where they're unable to get to some significant traction, be it 100 B2B customers or 1,000 or 5,000 customers. And this is often, investors often want to see, like you might have heard a lot of times if you're talking to investors that, get some traction and, you're too early right now. We would like to see some traction. And you realize that getting to first 5 customers or first 10 customers is not necessarily enough. You need to make sure that you have a repeatable sales model where you can actually get customers through a defined customer acquisition strategy. And to get to that stage, you need to have some significant traction, because that's when you prove that you've got your product market fit. And as you start growing, as you start executing a company after launching, we find that most entrepreneurs fail to excite investors because they are not able to run their startup efficiently. What I mean by that is that often entrepreneurs, they face, on their resources. As an entrepreneur, you have limited time, limited money, limited connections, and you need to be able to prioritize well and make sure you allocate these resources well. We also find that entrepreneurs are often unable to manage their cash flows and remain profitable. One of the biggest reasons actually that startups fail are, because they don't have an understanding of their cash flows and they run out of cash. So as an investor, it's really important to understand that the entrepreneur is able to manage a cash flow profitable business. And finally, we find that entrepreneurs often don't understand how valuations work. As an entrepreneur, as a business owner, essentially, like your biggest goal is to increase your shareholder value. The shareholder could just be yourself or, some investors. Or if you're a publicly listed company, the shares on the stock market. But every operation and understand how that valuation connects with your operations. Now, when you start growing, we find that often entrepreneurs fail to excite investors because they are unable to work in teams, and we see a lot of problems cropping up within the teams. Founders are often unable to manage their boards, and governance issues crop up. And often entrepreneurs suffer from what we call founderitis, which is the inability to transition from a small team or a small agile team of just a few co-founders to say a larger organization. Also, we find that often investors look for companies which investors often follow the trends as well. And if you're unable to raise investment from, say, other sources, including your friends and family, that often becomes a red flag. Because if you're not able to excite investors for a long time, your inability to raise investment could be a big factor. A lot of that actually correlates with, your ability to pitch well. So final aspect about, getting investors excited is you should be able to effectively pitch your company in a short amount of time. And, typically that happens through what we call an elevator pitch, which is like a quick 1 minute or less than a minute long pitch, where you are able to capture the attention of your investors, of the people that you're trying to attract. We find that often entrepreneurs fail to attract, or pitch their company well, and you're unable to present the right information when asked to present. So typically, with an investment, the process starts off with a quick elevator pitch over, say, an email or through a phone call or a Zoom chat in today's world, or in the old times, as we say, is in the pre-COVID-19 era, actually in an elevator. Now, once you have that and once you grab their attention, typically that is followed by, say, send me your pitch deck or send me your executive summary. And then you might go and present them, in their boardrooms. So you should be able to present the right information in the right time frame given to you, and it should be tailored to your audience. So that's the final piece about, what helps in exciting our investors. Ash, do you have anything else to add here?
Yeah, and Nalay, thanks for that. My view. Yeah, no problem. Nalay, well, just one small point. I think you're glitching a little bit. So just if you want to turn off your video just to kind of optimize your stream, you can just do that if you don't mind. In terms of all these components, we've spent a lot of time trying to understand what the investors themselves are thinking, right? And remember, at the end of the day, the investors are smart individuals that are looking at your startup, and you want to make sure that you kind of check all the boxes. You got to check all the boxes with your customers and your investors, and so hopefully this has given you some insights, and we'll try to make it a little bit more real as we follow through, Ro. But back to you, Nalay. Go ahead.
Yep. No, thank you, Ash, for sharing that. I would also like to ask you that, who we have in our audience today, because then we can tailor the next phase of our session based on that. So, a lot of you shared that, okay, you are looking to raise funding right now, but I would like to ask, have you actually raised money before? So please answer the poll posted right now about, have you raised money before? And if you have, is it through friends and family, or as a loan from government grants, angel investors, or venture capitalists, or something else like crowdfunding, or you might have done an initial coin offering if you're a blockchain or based startup. Okay, thank you. We are seeing most people have not, but there are some people who have raised debt financing. There are a couple of people who have raised friends and family, some from government grants. There's one person who has raised some angel money as well, angel or venture capital money as well. All right. All right, I'm just ending the poll right now. Thank you, everyone, for sharing this. This is helpful. Okay. All right. I'm unable to end the poll. Why? Having some trouble with Zoom today, it seems.
I can do it. And I'll share the results. Most of the people have not raised money before. So you can kind of get an idea of that, that group of people. I'll share the results with everyone, just so you can kind of get an idea of the group and the feedback elements. It's very interesting to raising money is one of those things that is always a bit of a challenge. I think Nalay, I think you popped off actually for a bit. I think your Wi-Fi kicked you off. We were all here. Can you hear us now, Nalay? Okay, I think Nalay is still having a little bit of Zoom challenges.
Yes,
Nalay, are you there?
I'm sorry about that. Can you guys see the screen? Okay.
Yeah, just start sharing your screen again. I think we can hear you now, Nalay. So just Nalay, just stay off your video. If your connection to the internet is not good today, just stay off your video. We can just go from there.
Sorry about that, guys.
That's okay. Yeah, go ahead. I shared the results. I shared the results with everyone. So the vast array of people there's a very small percentage, I think only 1 or 2 people that have actually raised money from a VC. So I think this will be a powerful session for them. So why don't you jump into the frameworks, Nalay? Go ahead.
Yep. So I was saying that over the years, a lot of frameworks and canvases have played an important role in teaching entrepreneurship. And it was mainly started off by, the business model canvas created by a Harvard professor, Alexander Osterwalder, who basically talked about, who created this model for helping larger companies create new business models. But it got really popular with startups. So we see the business model canvas being used since 2005. But then in 2010, there was also a lean version of this canvas being created. And it looked a little bit more, it looked the same, but it was a little bit more tailored for entrepreneurs, focusing directly on the problem and the solutions. Now, over the years, having taught these canvases or having used this, we found that first of all, they were not necessarily built to help startups execute or raise money. It was good in the initial stages of designing your startup or just getting your thoughts together, but its efficacy beyond that just fell short. Secondly, we found that, because it focused a lot on 30,000 feet view of the company, while founders need to zoom in and out between their high level of the company and the ground realities. And, it does not provide actionable insights for founders. And often, it does not help startup founders in the key elements of the startup journey, specifically around raising funds. So, we've kind of used different frameworks over the time, and we decided to, create something which was way more applicable for entrepreneurs. So we created, last year, actually, we started off on a journey, me and Ash, on creating like a new version of a canvas that entrepreneurs can use for building their startup, for making sure they capture all the elements of their startup and avoid the blind spots. So this was the version 1.0 of the Startup Course Canvas that we created, which was based on the research of the 12 steps. But more recently, we have just built in a version 2. So what you're seeing on the screen is, and I'll go into details of this, is a new version of our Startup Course Canvas, which takes you from a journey of starting an idea all the way to fundraising and raising capital. So this is essentially some of our work over the years, which helped entrepreneurs raise a lot of money, but at the same time, like, avoid blind spots in building your business itself. So let's dive deeper into this. So let's start off with the first framework that we get into, the ideation. So when you zoom into this, you find that, okay, there are some idea triggers that we use to create, and you can essentially create, add sticky notes, to this canvas to build it. But once you have a good idea and you're starting off with that, the next step is to make sure you have the right foundations. So by right foundations, I mean that you need to make sure that you are you have the fundamentals of your business right. You have the right ownership structure, the legal entity. You are incorporated and operated, and you're operating in the country where it makes most sense for you. It fits with your personal lifestyle, and you have the proper legal and financial support in terms of lawyers and accountants for your company. And then what we find is often entrepreneurs fail to understand how to split equity among the founders. So we have a quick framework, again, and you can use sticky notes to add this, to understand, to basically, identify what each founder is bringing to the table and how to split equity between them based on this. And there's a video that explains more about these concepts. And then we also have a more sophisticated tool that helps you understand the co-founder equity split as well. So that's the first step. The next is, we talk about thinking big. As an entrepreneur, you need to have a moonshot that you're aiming for, because investors are not necessarily interested in just, a small lifestyle business. They're essentially interested in funding moonshots. So the way to think about it is identify, the social and environmental impacts that your startup will have. Who are the people who will be impacted, and what's the greater purpose of your company? And finally, what's the breakthrough technology enabling you and the financial impact that you're going to make. With that, you will come up with what's your moonshot. And once you have this, and again, using sticky notes or Zoom annotations, you can just add on your comments here. Identify what is your mission statement, what's your vision statement, and basically how does that align with your company's operations and goals. Once you have that, the next step moving on is we talked about finding the right value proposition. So finding the right value proposition, again, we have a quick video about that too, but it starts off with understanding what products or services that speak to your customers most powerfully. What desires do they speak to most powerfully? And you start off with what the basic human desires are. As human beings, what are our needs? And then, as we grow, we have a bit of, we develop a bit of wants as well. And, we have certain desires that fall into learned desires categories. And these are some of the learned desires. So if you think about any great product or service, you'll find that they do a really good job in speaking to multiple of these desires. So you have to think about your product and service and identify what are the key, human desires, or the basic ones, or the learned desires that you're trying to address. Once you do that, you identify what are the pains of your customers, what are the gains that they're expecting, and what are their needs. And based on that, you get into identifying the right features, the experience that you're providing, and the benefits that you provide to your customers. And from that, you basically create your good value proposition statement. A good value proposition statement should communicate concrete results on a monetizable pain. And that's really important part about a good value proposition. The next from that is assessing the market. So again, investors care about what the opportunity is and how much of that are you able to capture. Start off with identifying a total addressable market. What's your serviceable available market? And what's your serviceable obtainable market? The TAM, or the total available market, and the SAM provide insights to your investor about the upside potential of your startup. The serviceable obtainable market essentially helps them de-risk the business, that this is what you are able to capture. Moving on from that, investors care about your minimum viable product and understanding if your customers love your product or not. So what you need to do for that is, there's a concept of user journey map, and you need to create a user journey for your customers using your product or service. So identify the major steps, the key steps which included as part of your user journey map. And again, we have the example of Tinder here that so this essentially gets into the details about identifying the first steps, what your product or service provides, different phases of the steps of this process. Identifying the actions that the users need to take, and identifying the experience. So for instance, when you start off on Tinder, and we're married, I'm a married person, Ash is married as well. But, we find that, Tinder is a good example because, first of all, it's a great product in terms of its user experience. And most people understand how it works just because so simple it is. So you start off with an onboarding process, okay? You set up your profile, then basically you swipe left or right, and you see the emotions going through it. So when you're starting with the onboarding or your profile setup, you're not necessarily that excited. You're setting up the same you're writing in your bio, or you're filling in the details regarding yourself. But you change that quickly as soon as you start liking. So once you start liking, again, you're on a little bit of high, but then after liking or swiping a lot, until you find a match, you're still on a bit of lows. But then when you find a match, you're on your highest point of your emotions when you're using this app. You start chatting, okay? And then you get excited all about meeting up a person in real life. So this essentially captures the, the different emotions and thoughts, and these are different actions that, a user takes while taking this journey. So use this, but to understand the concept, and then just build out a user journey map for your own product or service. Once you do that, the next step is to make sure that your customers really want what you're providing. So for this is called the customer development process. And the way it works is you start off with, with this framework here, you start off with, identifying what problems you're trying to address. What is the solution that your customer, that you're proposing? And does your product actually provide the solution that you're proposing? If you identify that, okay, if you validate this, then the next step is, are there enough people looking to, buy your product or having the same problem that you're trying to solve? And if there is, are they actually willing to pay? So the way you do it is you first list down your hypotheses, or you list down your, assumptions about these, and then you go out and talk to your customers. You talk to your customers and you find out, oh, the problem that you're trying to solve is actually a little bit different than what you originally imagined, or the product actually does not really satisfy the solution or provide the solution that you're proposing due to some other factors. So you go and you pivot to another version of your problem, solution, product, and market. So you go through this process over and over again until you find what we call a product market fit, until what your assumptions are aligned with what your customers actually feel, like the same problems, the same solution, the product that you're providing, and the market existence. Once you do that, you're able to you're ready to go to the next step. We've created something called the customer development bingo, because everyone loves bingo, right? And if you're able to answer these questions and do yes, okay, do your customers realize the same problems? Is the problem big enough for your customers? Are the customers excited about your solution? All of these factors, if you check all of these boxes, if you're able to tick off these boxes, that means you've achieved product market fit. So this is essentially just making it a little bit more fun. And the way we have kind of designed these frameworks is so that you can spend, an hour or two at these, to just fill this out, and then and essentially cover those aspects for your startup. So the next one is execution modeling, and we talked about customers often the entrepreneurs often failing to allocate their scarce resources well, or able to prioritize well. So what we have is a quick, you identify, your list of 20 activities without undertaking which your startup will die. This is important because this triggers certain aspects of your startup which you might not be thinking about. What are the most critical aspects or action items that you need to do as part of your startup? And then you start prioritizing this in terms of what is urgent and important. And based on that, you decide what things to do first, what to do later, what things should you delegate, and what could you eliminate. So once you have that, then you can essentially map out your key activities on your workflow timeline and identify, what would your startup or key activities look like in the next year or two. From there, we move on to the next step around financial modeling. So this is a part where we feel often entrepreneurs fail to understand how your finances work, and they often don't necessarily understand the cash flow components. So while yes, financial literacy could be a problem, or just the ability to build models could be a problem, but essentially you need to understand how are you making money and where are you spending it at the very basic. And when you think about making money, what are your revenue streams? What is the price point? What is the cost of sales? What is the cost of providing your product or service? And you identify those, and then you kind of identify into what are you spending the money on? What is a team? Expenses, what are the space and operations? Are your fixed expenses? what are your marketing and sales expenses, and if there are any additional or miscellaneous expenses as well. When you start identifying this, and then we have an Excel template or a Google spreadsheet template that you can actually go to and build out your detailed financial model. We also have some useful terminology that you can read here, and there's more information provided on this video as well. Now, the next step on the journey is identifying what a value creation event is and understanding how your company's fundable events align with your valuation. By fundable events, specifically what we mean is value creation events. And because this session is about fundraising, I think this is an important topic for everyone to understand. Let me play this quick video for you to understand, for you to understand this aspect. So let me play this video for everyone.
Fundable event timeline, valuations, and exit. For this lesson, you'll need to take a moment to consult with your crystal ball. What does it say about the future of your company? Who's doing what to make that happen? You need to show investors and other shareholders, boards of directors, and leadership teams your intended path for the company and how these decisions will impact the value of the company. Tracking value creation, value erosion, and value destruction is important. The difference between the three is often determined by the quality of the planning and execution by your team. Of course, you want to create value and not erode or destroy it, but you need to develop the skill of tracking how different paths in the company do one or the other, so that you can defend your decisions. So, does your crystal ball show you and your team swimming in a pool of money? I hope so. By the end of this lesson, you will better understand ways to plot the value impact of company activities, how to think about the valuation of your company, and how to think about potential exits. This company is not till death do you part, it's till payoff do you part. Stakeholders like to see that you understand more than just the current state of your company. They want to know that you're critically thinking of future steps and how those steps will affect the value of your company. As an entrepreneur, you need to always be looking forward as well as knowing where your company stands today. All right, so your crystal ball isn't showing the results you want. Maybe you should consult your computer instead. Take the Gantt chart that you built earlier, along with the cash flow, and put them together on one page. Put the Gantt chart at the top half of the page and the cash flow at the bottom half of the page. Line up the months on both the Gantt chart and cash flow so that they're perfectly lined up. This way, an investor or board member can look at it and see that the activities that you're showing in the Gantt harmonize with the numbers that you're showing in the cash flow. Here are a few things to consider. There are three basic parties involved in an exit of a company: the shareholders, the founder, and the company itself. The three perspectives of an exit are important to understand because they're not necessarily the same. The company's ideal exit. It might be in the company's best interest to never be acquired. It could be that the company will achieve its best and fullest potential if given ample time to grow and build strength upon strength. Alternatively, it might be in the company's best interest to be acquired sooner rather than later so that it can take advantage of a larger company's workforce, deep pockets, and economic power, as well as mature worldwide distribution network, etc. Every company is different, and you need to think about what might be in your company's best interest. Consider how you want the business to develop, and if an exit would help you meet these goals. Note that an optimal exit for the company may not be the same as an optimal exit for the investor, shareholders, or the founders. The founder's ideal exit. First-time founders will sometimes make the mistake of telling investors that they want to stay in the company for the rest of their careers. Although this might be true, less experienced entrepreneurs will say this, hoping to demonstrate enthusiasm and commitment. But this message actually is unsettling to investors and potentially other founders because they don't want to stay vested in the company for the rest of your life. They're investing and getting involved so that they can make money and get out on top after a few years. The best answer to give an investor is that you will exit in whatever way and at whatever time is in the best interest of the investors. Of course, most founders want to exit to gain financial security and minimize risks, while ensuring the core team that built up the company is well rewarded. The shareholders' ideal exit. Investors and shareholders need to understand how and when they will get their return on investment. Different investors have different timelines and expectations, so do your homework. It could be that a recapitalization recap would be best for everyone concerned. This is when you bring in new money and new investors. New investors, or possibly a second fund of your current investors, would come in and buy out your current investors. This would allow your company to continue on its own and yourselves to stay involved. Sometimes founders exit on a recapitalization. Sometimes the founders and/or employees could be the recapitalization investors who buy out the current shareholders. There are many combinations and ways to structure an investment. It could even be that a merger and/or acquisition, M&A, would be the best for everyone concerned. If another company buys your company, there would be some combination of cash and ownership in the acquiring company. There are many possibilities. It could be that an initial public offering, IPO, would be the best. If you have 4 profitable quarters, healthy numbers, and a healthy company, then maybe the board and shareholders would vote in favor of going public.
All right. All right. So hopefully that video provided you some perspective about valuations and exits. It's important as an entrepreneur for you to understand that, because as I mentioned that, as an entrepreneur, as a business owner, your biggest goal is to make sure that you are you're aligning your company's operations with its value. So the way you work this framework is, you start off with, identifying the key milestones for your next 2 years. You identify what your product stage would be in month 3, month 6, year 1, year 2. What would be your team growth? What would be the market traction? The funding that you would raise at different stages or what you'll have, and your expected values at this. The goal around this is to make sure that you achieve enough fundable events that prove that you're on the right track. So what specifically I mean that, and you need to make sure that you prove that you can work together as a team. You can build something, right? Like build a prototype or build an advanced version of the product that exists in the market. You are able to, get your first customers and clients because that means that someone is willing to buy this or use this. You're able to talk to investors, even a small financing round, or you're able to build audiences. You're able to, get to 1,000, 10,000, or 1 million customers, users, and so on and so forth. So fundable events are essentially these specific milestones that you are able to achieve in order to prove that your company is on the right track. So this is one of the important factors. And, Oren, you asked a question around bootstrapped companies and under what circumstances should you consider raising funds? So typically most startups are bootstrapped initially. The way to look at it is you try to identify, first of all, when you set up your goal, right? When you set up your bigger, moonshot, and assess the market opportunity, you need to identify what are the key milestones that you need to achieve in order to reach that moonshot. And in that process, what is the market traction required? And then you can work backwards from there that, okay, in order to achieve this market traction, I would need to invest X, Y, and Z into marketing. And I'm unable to manage my cash because I would need a lot more capital or liquidity to invest there. And that's when you decide, okay, this is the right point that I need to get into the fundraising mode. So again, it all starts with aligning your operations with your with essentially the key metrics and aligning that with your goal. So once you have that, you'll have a clear picture about what are the different steps that your startup need to achieve, and then how much funding you would need to achieve those. I hope that answers your question, Oren, to some extent. All right. So the next one is around teams, boards, and founderitis. So again, like what we found is that, the ideal team structure should consist of 3 people or 3 kind of personalities: the hacker, the hustler, and the hipster. The hacker is typically the builder that, loves creating. The hustler is someone who evangelizes the company constantly. to build partnerships and whatnot. And the hipster is the person who makes the product or your service really appealing and cool for your customers to use. So you need to have all of these aspects, well balanced out in your team. So what you do is you start off by identifying what skills do your co-founders bring to the table. And then from there, you get into understanding what skills do you require to build your startup, and how can you fulfill that? Do you need to outsource it? Do you need to add team members, or can you add advisors, or can you find advisors to bring that credibility to your team? So that's the team modeling framework. Finally, the one after this is understanding about getting investments. So this is again, this is kind of important because you need to understand where to look for money. Okay, there are different kinds of funding avenues. You can get some government grants, some debt, friends and family, angel investors, or venture capitalists. How do they essentially, how do they get their money back, or how do they get their return on investment? How much time do you need to spend with them? How much equity you need to give up, and how much money can they typically invest in your company? So this identifies those details. And then you need to understand that fundraising is often a full-time job for a founder, especially if you're doing it for the first time, and you might not have experience, or you might not have networks to begin with. So the way it works is we've done some research, and what we found is that it takes anywhere between 10 to 15 weeks in order to raise your funding round. It takes lesser time when you to raise your Series A or your second or third round, but your first round, it easily takes about 15 weeks or 10 to 15 weeks. On average, it takes around 11.5. You need to contact a lot of investors. Okay, what we find often is entrepreneurs talk to 2, 3, 4 investors, and they might get a response, good or bad, and they just base their judgment based on those initial 2 or 3 interactions. Hey, I talked to 3 investors, they're not interested. I don't think this is a good business. The fact is that you need to kiss a lot of frogs in order to find your prince. And you need to take up a lot of investor meetings and contact a lot of investors in order to fundraise. So as you see here, you have to take about 58 investors being contacted for your seed round, and about 40 investor meetings that you need to have before you actually close your seed round. And we often get asked this question about how much money should I raise for in my seed round? Should I raise for 6 months, 3 months, 1 year, 2 year, 3 year? And data shows that most entrepreneurs actually raise for about 18 months in their seed round and about 21 months for their Series A. So that's the runway that you need to aim for while raising your funding. This is this is based on data, and then once you have that, you identify your capital strategy framework, where you start with what your expected close dates, what's the funding amount, what's the runway that you're seeking. Let me go down. What are the funding sources? What's the pre-money valuation? What's the funding type? And what are the fundable events that you're looking to raise? Once you have that, the next things, it actually gives you a good perspective about how to fundraise. We also have a tool, an equity dilution simulator, which actually helps you understand the impact of raising investments on your own ownership of the company. So that's the framework on fundraising. Finally, we get into elevator pitching. So this is what we'll be doing now for the next 20 minutes or so, 22 minutes that we have in the session. We'll start off with, I'm an introvert. I'm a nerd. I'm an engineer who, grew up with limited or no business knowledge. And I found it really difficult to pitch early on. But, what we found is that there is actually, you can actually templatize your pitch, and you can just practice to get it perfect. So there are ways to improve on things. And, if you're able to build an awesome product on using some of the coolest technologies, presenting a pitch should be easier for you. You're smarter than that. It's just you need to make sure that you're putting in the right effort and you're presenting the right information. So the way to do it is you start off, and typically when you think about 60 minutes of a person's time when you're presenting something, right? You have to understand what does your audience, what are they expecting? What are they looking for? So for instance, you start off with, in the first 10 seconds, the investors are mainly thinking about what is it? What is this about? Right? Just trying to find out, to anchor essentially their thoughts. And you need to do that really well by making sure your one-line pitch is sharp. So again, we use the same template that we talked about earlier. My startup is developing an offering to help customers solve a particular problem with some of the secret sauce. That should essentially set up a good base for for developing an understanding of your company. The next is understanding the pitch. Okay, you get into a little bit more detail where the investor is thinking about, does it fit my investment criteria? So you get into details about what does your company do? How do you compete against your competitors? What's your business model and such? And the last is you must end with an ask, because at that point, the investor is thinking about, do I want to spend time with this? And, if you're like, it depends on what your ask is. It could be something as small as, hey, would you be interested to find out more and set up a follow-up meeting? Or it could be something more like, okay, hey, we are raising a seed round of about $500,000 and need some, and are you interested in this investment? It could be something as big as that. But again, it depends on your situation, depends on your company, and depends on the investor too. So that's typically the framework of the investor. One thing that you need to, with your fundraising, what you need to do is you need to make sure that you're planning your strategy well. You need to identify which investors you're going to contact, when are you going to reach out to them, and where are you going to reach out? Where are you going to find them out? So you need to map these out and prepare like a list of investors to reach out to. And you might find that initially you might want to reach out to investors who are more like, who are either your friends who will give you good feedback, or people who are not necessarily, who are more, okay towards helping entrepreneurs, first time, because you might be making mistakes in your pitch or your due diligence process. And then later on, you want to go for the big guns, the Sequoias of the world, once you have some practice and once you've ironed out all the errors. So that's around elevator pitching and your pitch and your investor outreach strategy. Finally, again, we talk about the pitch deck configuration, and this is once you have done this part well, you are often invited to get into to a boardroom to present to your investors for, say, a longer presentation. So again, we have a pitch deck template that you can use, and also an executive summary template that you can generate for this. So that's all from on this. We also have a framework about navigating a startup in the COVID-19 world. We talked about pivoting your startup in this COVID-19 era. What's important is that like I urge everyone, every startup entrepreneur right now should do this. Just look at your industry, spend some time thinking about what are the new consumer behaviors that this is enabling, that the COVID-19 is enabling. For example, like we saw a lot of increase in e-commerce after SARS in early 2000s, right? Are there new ways of working, right? For instance, we saw a lot of women joining the workforce after World War II. Are there policies affecting your industry? We saw a big policy change after 9/11, especially in the aviation industry, right? So similar to these, like, are there certain new consumer behaviors, new ways of working, or new policies that affect your company and your industry? Oops. And from that, you try to identify, is there a new business model that you could exploit? Or are there new channels that you can leverage? Or are there new products or services that you can introduce? So, having this is actually like, helps you navigate the COVID-19 pandemic really well. So, this is something that we have created a quick framework to navigate, to help entrepreneurs navigate the COVID-19 pandemic. So that essentially constitutes the startup course canvas. Ash, would you like to add something to it? before we jump into that?
Yeah, I think I know there's a lot of information here, and keep in mind what we're trying to do, and I think Nalay, you mentioned this briefly, but just understanding your blind spots, right? Every investor, no, I don't think that there's many investors out there that have such a holistic exposure to what you're trying to do. But when you're pitching an investor, you don't know who you're going to put yourself in front of. And so right now, if you talk to an investor, and we've had a couple of our startups talk to them, they're saying, they're asking us about what's our COVID-19 strategy. Okay, so we have something where you can have an intelligent response around that. So making sure that you're prepared, right? It's this element of preparedness, because we've also mapped out how much time you need to spend and how many investor meetings, but you want to make sure you're ready for it and be in a position where your first, second, third pitches are a lot more fruitful, and you don't waste your time with these pitch sessions, and use that to learn. Have yourself prepared beforehand, right? Nalay, back to you.
No, thank you. Yes, I mean, it's essentially like, it is all about being comprehensive and having having done the prep work. And, as entrepreneurs, we understand that, you're busy to think about all the different steps. There are too many things vying for your attention. This canvas helps you, spend an hour or two each on each of these frameworks, and within within a day or two, within 2 days, depending on how long your days are, but within a day or two, you should be able to map out, all the different aspects of your business and be prepared much better to talk to investors. And that's the whole purpose of us building this canvas. And the reason why we are able to do this is not because, we're smarter than anyone else. It's just we have seen too many entrepreneurs failing to address the basic fundamentals of their companies. And, it pains us to see, really smart entrepreneurs working on really cool technologies, solving a really amazing problem, unable to succeed or raise investment, or, because they have a blind spot or two, or they have certain red flags on their team, or on their milestones, or the metrics that they track, or something else, or they're not able to pitch well. So that's why, this helps you in identifying and covering all your blind spots. And it's very comprehensive, and it's based out of research. So, that's our intention of building this, and hopefully you'll find value in this, and for your own entrepreneurial journey. All right, so let's move on to the next the next phase of our of our session today. So we do a live pitch today. So we if you are willing to present your company, and what we'll do is we'll make you a panelist, have you share your screen, share your video, and then present a live pitch to us and to our audience. So please type in chat if you're willing to pitch today. And
yeah, we don't have too much time today. I know we went a little bit long, but you feel free to share your idea. You never know how it goes, and practice is also always good as well. So I know there's some people that have come for some of our other sessions before that are here again. Always a pleasure to see you. I see some old friends. Yep. Oren is here as well. Yeah. So is there somebody that wants to go first?
Yeah, Adam just was the first person to mention, and Say mentioned as well, willing to pitch. Maybe we'll start off with Adam, because you mentioned you want to pitch. Shall we start off with that?
Sure. Let's.
And Adam and I chatted yesterday, actually, Ash. So
okay.
I've heard his pitch yesterday, but
no
we
problem.
had a brief conversation, 20-minute
no
conversation
problem.
yesterday. But let me allow you to talk, Adam.
And we'll get Adam on board. Adam Beal, welcome.
So Adam, are you able to speak?
Yes, can you hear me?
Right.
Yes.
So what we're going to do is we're going to simulate an elevator pitch right now, Adam. If you want to throw your video on to make it real, and what we do is I have.
Let me promote you to a panelist.
You can
yep.
just get them on.
Yep.
And now, yeah, go ahead.
You can start off your video as well.
Yeah, is my video working, Malay? My video is on.
Okay, yes, I can.
Right now it says I can't start video.
Okay, yeah, give Zoom a couple of
I
seconds.
don't see your video. I don't see your video too.
Let's see here.
Let me stop sharing the screen as well. So that might be your video.
It says you cannot start your video because the host has stopped it.
Oh, that means I have stopped your video. Okay. Well, what we're going to do, Adam, let's see here if we can change role to attendee. No, I don't know. Let's make him a co-host. Let's make him a co-host. Adam, we're going to make you a co-host for a while.
We can't see your video either.
I can see Adam's video now. Adam, can you see me?
I can.
Okay, Adam.
Okay.
So Adam, we're going to try to make this as real as possible. Adam, you and I, have we met before?
I don't believe so.
So this is going to be like a kind of just a anonymous kind of experience, right? So there's no background. I know you know Nalay. So let's try to make this as real as possible and see where it goes. So what we're going to do is we're going to go through an elevator pitch. I'm going to start, if you see what's happening right now, we are,
I do. I see the elevator behind you. It's pretty awesome.
Yeah, so this is, we're simulating going up 102 floors of the World Trade Center. And what we're going to do is this is going to be a learning experience for everyone. So Adam, thank you for going first. And so this is going to continue up, and you can kind of see over here how many flights we're going up. And what's going to happen is I'm an investor, and you have an opportunity. You have 1 minute, right, to make that impact. And what's going to happen is in a couple of seconds right now, I'm hitting the top, right? Reaching the top floor. Okay, this is 102 floors. Okay, and we go off. All right. So your time is going to start right when I zoom back down. Watch how fast it goes. Okay, I'm back down now. Are you ready, Adam?
I'm ready.
Adam, how you doing? My name is Ash Singh.
Hey, Ash. Good to meet you. I'm Adam, and I'm the CEO of Aware AI. Aware AI is the digital twin for the driver. There's a problem with current vehicle development processes, and what it is that it requires a physical car to be built to understand how safe or distracting a car will be. We've built a software tool that can provide those same types of insights, but it does so at low cost and quick speed early on in vehicle development processes to save time and money for manufacturers and to improve safety for drivers.
Okay, interesting. And what do you need from me?
Well, we're currently looking for angel investors to raise an angel round to help us land our first paid pilot with a major automaker.
Got it. Great. Thank you very much. Your 1 minute is up. Okay. So Adam, what we're going to do is we're going to give you some real feedback on this, right? Authentic, real feedback. Now, one of the other things you find when you are having an elevator pitch or whenever you talk to an investor, Adam, more often than not, like 95% of the time, they're never going to give you real feedback. Okay. Sure. They're going to be like, thank you, thank you for coming. Great job. But in this situation, we want you to get better, right? We want you to elevate your game. And so we're going to talk a little bit about your idea. So I'm going to break it down, and Nalay, feel free to jump in if you want to add your 2 cents as well. So I think it was a good first pitch. I mean, usually when we have our first couple of people on, it's not as powerful. So clearly you've spent some time to, you have some good fundamentals, right? And when we think about an elevator pitch, the first thing is understanding what it is. Then you want to address a couple of points around how the business, a little bit more about the business to align with the investor. If there's a good fit. And then finally, you want to have an ask. There's kind of like those 3 components. And so when you were pitching your idea, the first component about what it is, right? What I felt is the secret sauce of what you were saying was missing, right? Being able to really understand what your technology is and how it's going to improve the process of safety or manufacturing or something like, you know what I mean? I was trying to understand that. And it's important for you to recognize that when an investor doesn't understand that fully, and that's why simple English is always good, and your English was fine, and I think the words you used were fine, but sometimes other people will use complicated terminology and you'll just get lost, right? You're like, I don't fully understand. So remember, the investor is thinking about what it is. Does it fit my portfolio and what I'm trying to do? And is this business really going to be something special? And then finally, do I want to hang out with this dude for the next 3 to 5 years, right? So you have to have an element of likability as well, right? So that's kind of how I would think about it, right? And there's also indications that you'll see. So I gave you a couple of clues today. Coincidentally, Adam, I'm wearing a car T-shirt on my screen, on my shirt, right? We could have talked a little bit about that, right? You know what I mean? So weave in a little bit of time to build a little bit of rapport with the person that you're talking to, right? I always try to bring a little bit of elements into the pitches to give you guys a bit of a clue of, So just coincidentally, we're talking about cars today. So the thing is that starting off, let's address that point. What is your secret sauce, and what you're doing going to change, transform, revolutionize car safety or car manufacturing? Give me some feedback on that.
Sure. So the secret sauce is that the metrics of human performance that we predict no one else can in the world. Physical testing is the only way you get those today. And the way that we change transportation is we allow design teams to iterate hundreds, if not thousands of times more on a specific vehicle compared to their competitors. Okay.
All right. Nalay, do you understand that? Or should we elaborate a little bit more? Now, you're the engineer. Nalay, you're the smart engineer.
And I spent some time with Adam yesterday just trying to understand. So probably I'm a little bit ahead, but and it has to be like, and we talked about this earlier as well, that, you have to make sure that, the message that you're providing is actually simple to understand for your audience, which might not be, people from the industry or people having the same technical background.
Yeah.
It's a little bit tough pitch to kind of put in simple language because the target user is typically a PhD in human factors engineering at an automotive company.
Sure. So Adam, the thing is that that's where your challenge is, right? Remember that the investor, if you're trying to look for money, might not be a PhD. They might not be a master's student. And remember, every pitch is different, okay? Right? So what you want to be able to do is like, I think your end user, right, might be a PhD person, right? Somebody who's got the right understanding. But you need to be able, every pitch is different, and you need to be able to dumb it down so even my 9-year-old son would understand. And it's frustrating, okay? But at the end of the day, you need to get money. And if somebody else has money, you just got to do what you got to say, what you got to say. Do you know what I mean? So let's try. I'm going to try to pitch your idea to you, right? I mean, it's easy for me to critique, right? And Adam, we've never met before. It's easy for me to critique, right? But it's harder for me to try to pitch your idea. But I still need to get the secret sauce, Nalay. I need to get the secret sauce. It's still not clear to me before I can pitch it back. What I understand, Adam, and I'm of reasonable intelligence, okay? I'm not smart enough to go to some of the schools that I teach at, but I'm smart enough to teach there, okay? So what I understand, what is the problem you're solving? Let me just ask that question. Is it around safety? Is it around safety?
It is. So you can think about when you design something like any vehicle or aircraft or any complicated system like that, you can use math to maybe simulate how something will perform under real world conditions, but you don't really know until you test it. That's why we use things like wind tunnels. That's why we do things like stress testing. So the human machine interaction component of these vehicles for a long time has basically been kind of kept to the theoretical. Designers and engineers use rules of thumb and math to predict, to try and build the best interfaces possible.
Got it.
But to really know, they have to build physical prototypes and test them with people. That's the problem with the current
so what you're saying is that when you think about safety, are we talking about car safety? We're
talking about safety, but we're also just talking about driver satisfaction and ease of use. So they're one and the same. You make an interface easy to use, it's also safer.
So the driver experience.
Yes.
Right? Now, driver experience is kind of vague, right? Because you want to talk about like a pain point, right? So is it safe for you to say that your driver experience is more pleasurable because you've thought about everything? Is that fair?
Yes.
Right, and including safety. Now, my question to you, Adam, is this: what do you do? So, are you saying you take their theoretical data and then you put it into real life stress testing environments like wind tunnels and so on and so forth? Is that what you're saying? You do? Like, what is what you do?
What we do is we take the digital designs. So we interact with the engineers and designers on day one, take those designs, we predict the metrics of human machine interaction that would be the outcome of a physical prototype in human studies.
And how do you do that?
Well, that's our secret sauce. So we build algorithms to do that.
Yeah, give me a little bit so I can help you pitch it back. It's kind of like you need to show me a little bit more leg, my friend. I need to understand. You know what I mean?
Sure.
You got to give me right. Is that fair, Nale? Is that fair? Am I asking for confidence? I just need to know like what you've thought about, right? You know, it can't just be a complete black box. You got to give me a little. You got to give the investor a little bit, right?
So we gather a variety of real world data, but more or less we gather video and other data of people driving various cars in the real world under different conditions and performing.
Got it. Okay, that makes sense. Okay, got it. That's helpful. That's very helpful for me. How much money are you looking to raise?
Currently 150,000.
$150,000. And how much equity are you going to give up for that?
We'll let the market decide.
Okay, you'll let the investor decide. Okay, Adam, what's your company name?
Aware AI.
Aware AI.
And it's AWAYR.
AWAY. Oh, okay. All right, Adam, should I give this Nale, do you want to pitch this or should I? Nale, what are you feeling? Should we put me on the spot?
Yeah.
Put me on the spot. Adam, I'm going to put myself on the spot. Adam, I'm going to ask you to just adjust your camera a little bit because I can't see your chin right now. I need to see your chin. I need to see your body language as I'm pitching to you. Okay, is that okay? You have a beautiful piece of artwork in the back of your house, by the way. So
glad you like it. Thanks.
Yeah. All right, Adam, I'm going to start pitching. I'm hitting the top, so I have to be fair in terms of time as well. And I'm going to try to pitch your idea back to you. Okay. All right. Zoom back down. All right, Adam, my name is Ash Singh, and I'm part of the Aware AI team. I don't know if you know this, but in the automotive industry, there's a huge challenge in trying to improve the driver experience. And a lot of the ways people assess an experience while driving a specific car relates to a lot of data. And you have all these PhDs looking at different components and so on and so forth. It's a very mathematical exercise. What we've discovered now in the advent in 2020, that we can leverage real world data, video content, and all this information around the world to create a powerful AI tool, which we call Aware, to help increase the experience of drivers and improve their experience by 30% based on what's happening now. I'm looking to raise $150,000 for 10 to 20% equity. Would you like to chat about it? So that's my pitch. Now you don't have to critique me. I'm just throwing it back at you. Okay, right? And so what, was that okay?
It was great.
Right. So what I tried to do was I was trying to explain the gap, right? There is a gap. There's PhDs, people looking at data, and then there's now a flood of information, right? There's so much more information out there that that is available for you and to leverage that data, right? And what I would have done if I could do it again is like when you think about how Tesla does autopilot, right? There's a lot of data now available that was never available before, correct? Mm-hmm. Right? So yep. I could have used Tesla as an example of how it's working and how they're improving their, but offering it to everyone, right? Because investors know that Tesla is winning, their valuations are high and all these other things. How can we leverage AI? And, so that could have been another way I would have pitched it. Okay. But that's my view. Nalay, anything else you want to add to Adam to add value to his session?
No, I think this is good. Yes, I mean, again, the problem with most, the deep technical product like yours is, associated with, how to present it in a concise way that makes sense for a lot of, for a, person who's not really experienced in this or does not have much knowledge about this. And I think that's a challenge that you have. But I think making the problem relatable to the average Joe is, or Bethany, okay,
yeah.
is important, right? It's something that is, that works most of the times, because again, your investors might not be as, as aware or as knowledgeable about the industry or about the technology that you're presenting, but can you make it relatable for any average person? And that makes it really powerful.
Yeah, I think also, when I think about this, I don't know how big of a problem this is, right? So what I would want to know as an investor, and you can do this in your pitch, is to say, bad user experience costs car manufacturers billions of dollars every year, okay? And using our technology, we're going to be able to allow them to implement a much better user experience testing platform, okay? Obviously, they'll pay us, but it's a small fraction of the value that they're going to derive from getting 5-star ratings from, JD Power and Associates and all the other driver car testing, people out there, right? So it's like this, if I have let's just take a typical car, a Hyundai car, right? What's the value for Hyundai when their car is getting a 3-star rating versus a 4-star rating on experience, right? What's the value to them, Adam? That's a huge value, right? Yeah. And if your system can leverage AI to kind of make that user experience better and let them think out more things, that's a huge value creation. Do you know what I mean? It's worth a lot more than $150,000 or whatever you're asking for. Okay, but you got to think about that, right? You got to be very clear on how that's going to go, right? But there it is, my friend. Adam, thank you for volunteering first. Nalay, do we want to bring anyone else on? What are you thinking today? I know we're a little bit over today. We're way over.
Yeah, it's 11:37. We're way over today. Let's wrap up today for now, if that's okay. Say, I know you wanted to pitch, but maybe you can join us next week. We do this every Thursday. So, you can join us.
If you don't mind, I know we went a little bit long today. It's 11:37. Nalay, I'll pass it back to you.
Sure. I mean, again, so thank you, Adam, for sharing your pitch. Just give me 1 minute. Let me.
Thank you for your feedback. Very helpful.
Pleasure. Thank you as well. So, just moving on, in terms of next steps. So again, there's a lot of times we get asked about, like, how would you, what's the next steps from here? Like, okay, we understand the things. So the way we accelerate entrepreneurs is through different ways. So our goal this year is to create 100,000 jobs, because what we see with COVID-19 is, I'm in Canada right now, and in Canada we are seeing over 2 million job losses. That's a massive number. And what we know is it's entrepreneurs who lead this the job creation and the economic recovery from the COVID-19 pandemic. It will be led by entrepreneurs, not necessarily by politicians. So our goal this year is to help over 100,000 or create over 100,000 jobs this year. And that's by enabling entrepreneurs to build and launch amazing companies. So then we realize there are different stages for an entrepreneur's journey. You could just be starting out, you're just learning, and then we have, for entrepreneurs just starting out, we have, like, if you're just starting out, looking for an idea, we have startupbusinessideas.com, where you can use that platform to create new business ideas. We run these live master classes. We have our group hyper. So that's for the learners. Now, if you are a little bit more advanced, you have you have a startup already. What we have is we have our award-winning program that includes the startup course Canvas that we just showed you. It includes course videos, a lot of templates and materials, and we also do skill-specific workshops. And you're basically part of a group of entrepreneurs where you can use the community for answering some of your questions. So that's our group hyper accelerator program. If you're a bit more advanced and you have you probably need a little bit more customized training on your fundraising strategy, or you're growing your startup, we work with companies one-on-one to provide what we call the personal accelerator, which is essentially we work, either me or Ash, or some of our other coaches. We join you as your non-equity co-founders and work with you, for 100-day sprints on different aspects of your business. Either it's capital strategy, fundraising, helping you with investor meetings, building your company and raising it. And it goes with early stages to we also help in with companies and IPOs or trade sale coaching related to your exits, having gone through the exit process ourselves. There's a lot of insights that we add in terms of things that you should be doing versus you should not. So depending on the stage of your venture and your ability, we engage with entrepreneurs at different stages. Ash, feel free to join in anytime on this, but this is what the Group Hyper Accelerator looks like. This is what our platform looks like if you're joining us for the Group Hyper Accelerator. This is you get an access to the startup course Canvas. This is the version 1.0. Version 2.0 is not formally released yet, but it will be released rather
the next week
soon.
or two.
Yeah, we're just finalizing the technical components of that. Yep. So that's that. We also have within the system, you have ways to kind of book one-on-one calls as well with myself or with Ash for a pitch event or for pitching, or either for scheduling investor meetings as well that we do through this. It's all done through the system here. And Ash, would you like to add something to this?
Yeah, I mean, we just try to make it as real as possible for you guys. So we're going to try and put you in front of investors. And as we start to scale now, we have, there's a couple of other components to this, but, I think people need to really rethink about how fast they need to capitalize their businesses, and also make sure that you have the right pieces to scale and scale fast, right? So when you went through the startup course Canvas, our hope is that not only do we help you with your entrepreneurial journey from a fundraising perspective, but you can also make sure that you have all the pieces mapped out so you could accelerate and move faster. Okay, so that's my component. Back to you, Nilay.
Yep. And the way for the group accelerator program that we have, the way we've chosen a not-for-profit model where you can essentially pay what you can depending on your situation or your budget. We understand that not everyone is as well endowed, and we have people from all across the world joining us, and we understand that the cost factors are different in different jurisdictions. So you can join us for as little as $1 to get started. It typically costs us around $99 or so, a little bit over that, to run the program, including the platform and everything else. But again, our goal is more so to make sure that we are able to create jobs for the next phase of the COVID-19 recovery, which is job creation and economic recovery. So again, you can enroll us for $99, $59, $25, whatever works for you, for this for the Group Hyper Accelerator program. This is the link for joining us, jobcreator.startupcourse.com, and maybe we can have Ash or Roy, can you post that into the comment section as well so that you have access to this?
Sure.
You'll probably get an email from us about this too, but you can join us. You'll have an access to the Canvas as well if you join in to this, and access to the course materials and the templates and everything as part of that. So that's it from us. Ash, is there anything else quickly before that?
Well, I think that's pretty much it. I think we had one last thing that we had for everyone. I know we're again over time, but
So, indeed. So, you know, with COVID-19, what we found is that a lot of people are, you know, are not able to graduate or have a convocation ceremony. So, you know, we really appreciate the time you guys spent with us today. So we would like to help, you know, you guys feel a little bit special about graduating. So please join us for the graduation ceremony. You can stand up as well if you want to. But you know, thank you for joining us today, and you know, let's help start graduation.
Nalay, is your audio on? There you go. I think your audio, Nalay. Let's get the audio queuing. We got to get the orchestra going, Nalay. You got to share with sound. Try a new share with sound. Let's get the audio going. Let's finish off strong. Oh.
Nope. All right.
Are you sure?
No worries,
Are you sure? You didn't have the, oh, okay. Oh, that's a sad thing. Well, the orchestra didn't perform today, right?
Yeah.
But all good. Gentlemen, ladies and gentlemen, thank you for joining. I know we went a little bit over time. It was a lot of fun. Nalay, let's go to the final slide and sign off for today, because I know some people are.
Yep. So just would like to leave you with this quote. Yep. And we also have 3 other events that we organize about why first-time founders fail. We talk about raising entrepreneurial teens. If you have a kid who's a teenager, we run a program for youth as well. And then if you are you know, if you're an investor, or if you're looking to become a startup coach or help startups, you know, sharing your expertise, then we have a session for that too. So that's it for today. I hope to see you all in the future as well. And we will be following up with an email as well. Thank you all for joining us today. Thank you.